So welcome everyone to our next session, which is Finance as a Lever for Change. And this session is about, I think, an extremely important element that hopefully will help us getting on the 2 degrees pathway, which is financial innovation and innovative financial instruments that really can enable us to unlock investment at scale in order to fill the current financing gap that we have. As we've done at CPI some work on, showing how much money is flowing at the moment, and what we see is that we have around $400 billion of global flows going into climate action at the moment. And while that is more than has ever been spent on climate action, so that's good news, we all know that we actually need the trillions to really get us on a 2 degrees pathway. So thinking about how we can, first scale up what we are doing now, but then really using public money most effectively to unlock private investment at scale is a core goal that we all have. And I have a fantastic panel here that will share with you some of the lessons that they do in their institutions, but also I'm very lucky to be actually managing one public-private initiative, which is called the Global Innovation Lab for Climate Finance, which actually has the goal of unlocking private investment at scale in emerging economies, and doing that through a crowdsourcing process and a competitive process where we then design new financial instruments under the guidance of a very high-level group of both public and private investors. And several of these high-level members of the lab are actually on the panel today. Both Vikram, Paddy, Tariya and Abid are actually guiding the work of the lab. So I look forward also to hearing from them a little bit on the experience. And Mafalda, and I'm going to introduce them more longly and in a minute. Mafalda obviously is key in helping us to think about what we can learn from some of the existing climate funds out there, as she's actually been driving a lot of the work, the thinking about how we can use also concessional finance most effectively in her work over the last years. So let me briefly introduce the panelists and then hand over to them for brief opening remarks. And then we're going to have a discussion here and also look forward to questions from the floor. So let me start from my very left, your very right. Vikram Vij, who is the head of the Climate Finance and Policy Department at IFC from the World Bank Group. And again, Vikram is a lab member and has also been a proponent in the context of the India lab that we also have established. And I think my colleague Girish, who is running the India lab, is actually here with us, so he can tell you more about that. Close to Vikram is Mafalda Tuart, who is the program manager of the Climate Investment Funds, which obviously is one of the core funds at the moment and can help drive investments in emerging economies. So we look forward to hearing from you. Close to Mafalda is Paddy Batmantan. I will never be able to pronounce you very is Paddy, who is the CEO from Aqua Power. And Paddy has been obviously key in driving some of the really important investment here in Morocco in the context of concentrated solar power, but is also a lab member and has been very active in trying to help us think about what project developers really need in order to get engaged in these areas. So we look forward to hearing from you, Paddy. Close to Paddy is Abid Karmali, who is the Managing Director of Climate Finance at Bank of America Merrill Lynch. And Bank of America Merrill Lynch obviously has been also a really key actor in thinking about catalytic ways of really getting to climate investments at scale. And so we look forward to hearing a little bit more about what Bank of America is doing, but also your role within the lab as well as an advisor. And last but certainly not least is Tariya Badgashin. She's head of the Heavy Industries and Telecoms division at the Africa Finance Corporation. And we're also lucky to have her as a lab member, but in addition, she also brings really valuable insights just from the work that they're doing also for one of the accredited entities to the GCF. So we have an excellent panel here. I'm going to hand over the mic to Vikram, and we're going to hear the initial opening remarks.
Thank you, Barbara. Thank you all for being here on a Sunday. I guess that was the only day a few years ago that the private sector found nothing else scheduled. So the World Climate Summit got formed, thereby ensuring we had to work through the weekend. Just to build on what Barbara said, and just to put some numbers in context, the most recent report by the Global Commission on the Economy and Climate says that $90 trillion are going to be needed in the next coming 15 years. Even if you took 2/3 of that to be supplied by the private sector, you're looking at $4 trillion a year flows from sort of financing by the private sector. You've been to enough panels by now to know that there are trillions available in savings, and the capital markets have further trillions available to be deployed. But the question is, how are you going to unlock that for sort of the low carbon resilient infrastructure and everything else that we need to build out? So I think therein lies a huge challenge in terms of doing what we all are trying to collectively do as the MDBs. The World Bank Group has about 60 million. IFC, which is the institution, the private sector affiliate I represent, has a commitment to sort of does about 3 billion a year. We hope it's catalytic. We are expecting to ramp it up to 28% of all our lending, sort of doubling where we are right now. But it's, again, the whole issue is about scale. How are we going to leverage this money? How are we going to leverage the concessional pools that Mafalda and others will talk about? And the key to that's going to be financial innovation, and not just innovation for the sake of innovation, but innovation that targets scale. We have sort of repeatedly said that you have to leverage the power of the capital markets, and green bonds are not only the theme here, but have been the theme for 2 or 3 years. And the green bond market is booming. But what are we going to do to provide the deal flow, if you will? How are we going to ramp up this market from the 65, 70 billion that it seems to have hit this year to actually a magnitude higher, if not even more multiples? And to that extent, I think you're going to have to focus a lot more on generating deal flow in the developing countries, figuring out ways to aggregate that, find concessional money and other financial engineering solutions to de-risk it, and finally, ultimately, put it into a form of a product. The term the financial market uses is securitize it into something boring that the big investors can use, also known as a bond. Make it, what we have learned repeatedly with trying to do innovation is you have to give the big investors something that they are already familiar with, something they can get their heads around, and worry about maybe the green or the low carbon or the resilient part of it, but the rest of it better look like the other trillions that they have invested in. So in that sense, the green bond market, but more importantly, its extensions are going to be critical. So I am actually going to sort of reserve some of the other remarks for maybe Q&A later, but I did want to highlight in that context one example from the India lab that Barbara mentioned. Not only are we sort of advisors and proponents or supporting projects in the global lab, but as IFC, we have live experiences to house one of these many innovation platforms, and I'm sure Abid will talk about another one that we are party to, is the India lab. Now, the India lab takes the global labs concept for innovation and makes it more country specific. And this is extremely important because instead of getting a global perspective, which is critical for incubating interesting ideas, you are actually now able to take that concept into a country level and look at it from an NDC perspective. India, 100 gigawatts of commitment to solar, 40 gigawatts of that from rooftop solar. There are ministers, there are regulators, there are local financiers who are ready to sort of try and address these issues in a domestic context. Now that's where the power of this convening from the lab comes. And we have been lucky enough to be selected as one of the 3 projects to benefit from this. It's a rooftop solar warehousing facility. Forget the name. It actually embodies the 3 things I said earlier. It is focused on rooftop solar. It looks at pre-screening developers and providing standardized underwriting criteria. So projects that are ready to go can get quick release money, are aligned to a particular approach in terms of how their creditworthiness is evaluated so that you can aggregate it, you de-risk it, and you securitize. That's our mantra. Even as IFC's core sort of new product group, generate the deal flow, aggregate it, de-risk it, and securitize it. And we'll issue bonds ultimately into the domestic market. And I don't think we would have gotten there if the lab hadn't provided the on-the-ground convening, the exposure to the regulators and ministers, and the analytical bandwidth that the, if you will, the Secretariat brings in terms of both analysis and market. And so stay tuned, and we will hopefully be delivering, and it's a $500 million, hopefully revolving warehouse, and the expectation is that it will at least, even in one pass, generate about finance 750 megawatts, and if it all goes well, it should be able to leverage up to 4 to 5 gigawatts worth of financing in rooftop solar. So I'll stop there, and we can come back for more specifics later on that or other issues.
Okay. I really like the title of this session, and you're calling it Finance as a Lever for Change. And the climate investment funds actually have been a testimony of this. And the first message that I actually want to convey is that if some of you are concerned about recent news and what it might do to our climate goals, I'm going to tell you a story of what was happening when the climate investment funds were established, which was 2008. You know what 2008 was the year of the financial crisis. And you know what 2009 COP was like. I don't need to, well, some of you that follow these COPs, you will know what 2009 was. So that was a time where, the risk perceptions and the appetite for investments in developing countries as far as low carbon investments, be it in renewable energy or energy efficiency or others, was not there. The perception of risk was very high, a number of barriers to investment. So the climate investment funds were established. This is a pool of public money, risk capital, cheaper capital, to drive these investments from public sector entities and private sector entities. And we've driven change. And we have tangible results on the ground in multiple countries. We are supporting investments in 72 countries worldwide. And we're actually transforming markets and driving cost of the technology down in CSP, and Patty will speak to that, I'm sure, and also speak to the very big CSP power plant here in Morocco, which we've been supporting very significantly. So we have demonstrated that the role that public finance can play at times where, most people might think, or investors might be shying away from moving, or even public sector entities, governments, concerned about making some investment choices within their own countries. So a message of hope that actually, with the right tools and with the momentum that is now created also with the Paris Agreement, with the SDGs, I think we just need to now take it to the next level. And I'll be talking a little bit about what we see the next level to be in line a little bit with what Vikram said. But at the time, from 2008 to 2015, what I have seen the role of public finance playing was in a number of ways. Certainly, and I see that role having to continue, and even more so, more prominently now, in terms of supporting policy and regulatory change. We do need to help the countries understand what are the key necessary building blocks at the country level in terms of policies and regulations to drive investments. I mean, in the renewable energy space, be it helping them with the feed-in tariff systems, with auction mechanisms, and so on. We need to put significant effort as well into what Vikram was saying, which is deal generation, pipeline flow. These things take time, and one cannot just expect these projects to emerge out of nothing. So public money needs to continue to play a role there. It has played that role so far, but at the scale that is insufficient. So these things, I think, remain from what we have seen to the next phase. I just think we need to emphasize it a little bit more. But in terms of investment capital per se, what we have seen is what we did was support a lot of first mover investments in a number of markets to basically reduce perceived risks, help bring the technology costs down, establish some track record of these types of investments. So we've done that in a number of technologies. I mean, if one thinks about the wind and solar PV right now, these are technologies that are cost competitive with fossil fuels in most countries, in many countries. The question is, they might still be difficult investments in certain markets because of not the cost of the technology per se, but other barriers. So one will have to use the right financial products and mechanisms to address the specific risks which are not associated with the cost of the technology. We still have other technologies like CSP, which are not yet cost competitive with fossil fuels, and we need to continue to support those. I mean, there was your analysis, Barbara, of CPI, that if public money from international institutions and national institutions would drive another 5 gigawatt or 15 gigawatt of investments in CSP, now it's already 5, it's even less of an effort, it could bring the cost of the technology down by between 15 and 45%. And so, again, you know, the role of the public money there in bringing this cost of this technology, which is an important technology, down. And at the same time, we need to look at other frontiers, so look at what is now what CSP was in 2008 and 2009. And where do we put the public money there to drive the sort of change that we are seeing in other technologies? So one of the areas that we are looking at very carefully is storage technologies. How can we push and drive that agenda because it's so important from an energy sector point of view. So this is how I see, you know, the critical role of that public money has played and will have to continue to play. I fully agree with Vikram. The question is the fact that we need to have pace and scale. So we were doing this. We are $8.3 billion, driving another 10 times worth of those investments. That's a drop in the ocean, but you know, we played a very important role in terms of demonstrating and creating markets and demonstrating that these investments are sound investments both to public sector and private sector entities. This is now the question, the pace and the scale. So, here again, you know, exactly what Vikram was saying, aggregate, de-risk, securitize. So we are looking at using our asset pool in one of our funds and taking it to this next level, and again demonstrate how, in the context of what we do, how we can place a mechanism, a structure in the market that will attract institutional investors.
Thank you. Good afternoon. I think both Vikram and Felda sort of pointed out several issues, and there's lots of innovation going on and lots of ways in which many of these things are being dealt with. At the end of the day, to decarbonize power generation, which by the way is pretty critical. So, in order to achieve the targets, we've got to. It's not just power generation. You got to deal with power generation, you got to deal with transportation, you got to deal with goods and services. There's so many things you got to deal with. But so transportation, when you decarbonize, well, you're going to end up having electric. So it'll all come back. So power generation is a very significant piece. So worth continuing to talk about it. To do that, so you've got to deal with technology. You've got to achieve scale. You've got to handle several issues, which some of them I'll just now touch about, and you've got to get it done with speed. Just think about this. So to deploy photovoltaic technology. You can deploy. We're doing 200 megawatts, one project. You can finish it in 12 months. But then people take, well, I know there are some places where they've been taking 12 years to create that project. And not this particular project I'm referring to, but create a project. So we got to get past that and find a way. And the good news is there are a lot of work that is being done, and all of it is being springboarded by public finance. So stop for 1 second and think about, we all talk about today, it doesn't matter, 6 cents, 5 cents, 4 cents, 3 cents, or the magic 2.54 in one place, photovoltaic tariff. How did we get there? We got there after deploying 400,000 megawatts around the world. The first several hundreds of thousands of megawatts was done on the back of feed-in tariffs, which effectively was subsidized public finance. Felder referred to CSP, an extremely important technology because it's dispatchable, it works day and night, we are able to store heat just over the mountain, Atlas Mountains here, 20 minutes by flight. There is a huge plant that's working perfectly well, day and night, dispatching about today 5% of Morocco's electricity, 4% of Morocco's electricity, fully renewable. So very valuable technology. Now that technology would have just died if back in 2000, a project had not been created here in Morocco. Very bold sort of decision at the time, because that technology was priced at 45 cents per kilowatt hour. It would never have been done if, first of all, Morocco had not taken what sounded at that time like a crazy decision, but it turns out it wasn't. A very brave decision. And public money coming together to de-risk it and creating the right framework and incentive. In one project, we were able to bring the tariff down to 18.9 cents. Of course, from then on, it's gone one way. We are sitting at probably 15 cents. And yes, no, we remain, because we are very heavily now involved. We have about more than 1,000 megawatts of this technology now. We can see the price path for it to become single digit within another few more thousands of megawatts of deployment. So public sector and private sector, when they come together, they create these sort of initial drives. Thereafter, the private sector then takes off, just like private sector. So you don't need any public sector money in many parts of the world. I'll come back to that just now. For photovoltaic, its deployment is ongoing. You now need public sector money to step in and de-risk and help in certain parts of the world to take advantage of this cost-competitive PV and wind that is available throughout, that is available for deployment. So what is the issue? The issue is renewable energy, significant capex, very low operating cost, and that capital cost we recover over 20, 25 years. If we try to recover it over 4 or 5 years, then obviously it becomes uncost competitive. But then we, in all these countries, we then generate the revenue in local currency. The more remote places that you go to, there is no local level of banking the traditional project financing liquidity. So you've got to find some way of but there is a lot of liquidity actually, even in the most remotest places, with pension funds. But then pension funds don't know how, well, they really shouldn't be speculating on construction risk. They shouldn't be getting involved. So you've got to somehow find a way of providing that infrastructure, getting that investment done, and then tapping into the pension funds once it's working. So somebody has to step up now and deal with how to fund the first, even if it's 14 months to build the project. Now there, public sector can play a role, and it's starting to play a role. There is absolutely no way that Zambia would have ended up getting a 6 cents per kilowatt hour photovoltaic tariff if it had not been done through the IFC-sponsored scaling up solar program. So the minute you start doing, so immediately on one project, just like that, I don't know, 6 months ago, I mean, the tariffs in that part of the world are 14, 20 cents, 18 cents. In one project, 6 cents. We're able to implement the minute you start. So, and then when you start thinking about rooftops, the biggest problem with rooftops is everybody gets it, the people are happy to pay for that, but how do you deploy that at scale and at speed? You've got to somehow figure a way of aggregating it. So you've got to figure out a way of getting it rolled out and then bringing it back grouped in and securitize the revenue and create more value. All of that will require, private sector is ready, there's lots of clever thinkers out there who are willing to work at it, but they will need policy support, they will need public sector financing to stand alongside them and take that initial step. But once you start rolling it and create the momentum, just like what you are seeing in other sectors, it'll just catch up.
Great. Well, thanks very much. And it's a privilege to follow these three eloquent speakers who've reduced the amount of time that I have to give to speak. No, which is good, because I'm going to build on the content. In fact, I mean, it's helpful because the perspective I'll bring, hopefully, is of a global financial institution that is interacting daily with different types of private sector. Don't forget, we have corporates as well as institutional investors. So perhaps the best thing I can do is sort of break it down into how I see the world through their eyes. And let me first of all say, Mafalda, completely agree with you. You know, the corporate and investor view is that the energy transitions are irreversible. Power sector is decarbonizing. Your point, Paddy, about increased electrification, I think that's taken as a given as well. And you know, the second point would be massive scale-ups going on in energy productivity. So don't forget about energy efficiency. Lots of opportunities in that area. And then, of course, the fossil fuel optimization, let's call it, that's going on to try and keep within a 2-degree budget. So those are the major trends. And investors and corporates can play in each of those different areas. You know, Vikram talked about the scale of the opportunity, so I won't highlight that again. But maybe let me say, you know, Bank of America, we have a $125 billion commitment over 10 years. One anecdote is that we've already deployed $41 billion in the last 2 years alone. So that tells you it's getting easier to get these kinds of deals done, which you know, should be, as you say, a message of hope. It's because the opportunities are becoming more available, it's because the policy environments are becoming generally more supportive, and it's because the expectations coming out of, you know, last year's events give a signal that the direction of travel is inevitable. How we source opportunities for investors is basically thinking about the different types of transactions. So, you know, I said it's important to think about the corporates. Well, the corporates are, you know, high carbon companies, let's say, are moving their portfolios, they're recalibrating portfolios. So that is more of a, I would say, an M&A type of opportunity. It's an IPO opportunity. You know, we've seen some IPOs of pure play renewable energy companies. That's a way of unlocking capital for renewable energy development in emerging markets. And basically, you have to have equity investors who are comfortable with the value proposition, with the strategy, and with the execution capabilities of those companies. Then, if we think about the pure plays, and I guess, Paddy, you're an example of a pure play. I mean, you've just highlighted the importance of separating out where different finance is required, because unfortunately, commercial banks are not going to take that upfront project finance risk. We're not really in the project finance game. Utilities generally are balance sheet constrained because of this other, you know, fossil fuel optimization issue going on. They're writing off, you know, debts year on year. So billions, yeah. So who's going to take the risk? Well, ultimately, it's pure play project developers, hopefully enabled by public finance, and it's private equity. So you know, one of the interesting trends for us is that private equity is now moving more into the project development space. Hey, if the risk is high and the return is high, I may as well get paid for it, right? I'm sure Paddy is experienced that many times over, given how large his portfolio is. But he also mentioned something very important, which is at some point, he has to recycle his capital, right? You don't have endless balance sheet. So you have to find a way to get your liquidity event. And you can be sure that the private equity guys want their exit soon as well. So that's where refinancing as a tool is so crucial, and that's also why, all three of you have mentioned securitization. That's fundamentally why securitization is so key, because it addresses the challenge of getting one bunch of investors out of the game and the new investors in the game who are more comfortable with lower risk, operating assets that can deliver reliable feed, yield we call it. So that's the importance. It addresses the other issue also of scale. If you can pool some of these assets into bigger quantums of investment opportunity, that's then attractive. So some of the products that we've been looking to deliver to investors are things like green asset-backed securities or green project bonds at scale. And we've now seen some good examples. Unfortunately, the ones I'm going to give you are in OECD markets, but I think it shows the promise of what's there. So, recently we did a refinancing of, in fact, Europe's largest ever renewable energy bond. It was 978 million euros, but it required unbelievable amounts of structuring, 46 different investors into 7 different tranches. So, that's, this stuff is extra fiddly, but it can be done. Then we did a green ABS in Spain. The Vela solar transaction, around, I forget how many, but several dozen operating solar plants, packaged up, securitizing the revenues, and pitching it out to institutional investors. And the buyers were both US and European. Those are some of the products that are going to be relevant. If we think more about emerging markets, I think that's where the likes of CIFs and the Green Climate Fund and Vikram, of course, with the IFC, have to play a role in helping to lower the cost of capital so that more of these transactions can get done. And then maybe just to close, I'll highlight a couple of examples from the lab, because it's been wonderful for us to participate in the lab, because we know we don't have all the answers. We know that this has to be a collaborative effort, and that you need to blend private, public, and sometimes even philanthropic capital to get these kinds of structures into market. So let me just highlight one. And I actually forget the name of it because it cleverly rebranded, and it's such a clever name I've forgotten. That's the one, Investor One. You knew I was thinking of that. So that addresses some of the issues that all of us have spoken about. Basically, it's a blended fund that has 3 different pieces to it, 3 different legs in the stool, if you like. The first leg is about project preparation, making sure, as Mafalda said, the deal flow is high quality. That's all public sector funded. That's ODA money. There's no way any commercial investor is going to pay for project preparation. The second piece of it is primarily around the issue that Paddy talked about, which is making sure that the appropriate investors are taking the risks up until the assets have, let's say, 1 year of track record. And again, that's mostly public sector money, but it's tranched to reflect the fact that there are going to be others who are willing to take that risk, other types of investors. Then the third piece is all about the refinancing. So once you have the assets that have been up and running for a while, then you invite other, hopefully private institutional investors to come in and invest in this by then, portfolio of operating assets. And that's a great example, I think, that came out of the lab. Lots of structuring, lots of discussion, but it exemplifies how you can pool, different types of investors in different parts of the value chain.
Thank you. So I have the toughest job here, going last. Great. So I think my perspective is actually going to come as an investor. So we are a hybrid DFI and principal investment institution that puts our balance sheet to work across specific sectors. We're also Africa focused, so I will bring that perspective to the panel as well. Now, we have we're in that unique position that we have a development mandate across some key sectors that we've identified, but we are highly commercial. So we have a shareholding comprised of governments that own 40% of the institution, and the balance is owned by the private sector. Now, why is that interesting for this discussion? We are effectively government, policy, and true hard-nosed commercial objective within an institution. And so we see very clearly the intersection of how all of those issues can come together in one institution, and we have been using that platform as we engage with climate finance. And so our accreditation at GCF has also been very useful in that regard. Now, when we were established about 10 years ago, we identified that one of the biggest challenges to delivering infrastructure in Africa was the need for project preparation capital and project development. And so some of the first projects we looked at, and the first type of human resources we hired, in fact, was to support that. And we found it to be an area of great need, and some of our most impactful projects were those that we were able to provide project development capital into, one of which was the Kabiolika wind farm in Cape Verde, which is a 28 megawatt wind farm that we invested early stage project development capital and follow-on equity to get it to financial close, and it was then funded by DFIs. Now, why is this really important? The need for de-risking capital, which has been identified, is very important for channeling private capital into climate finance projects. And we've experienced this firsthand, and we've seen its success. What we've also seen is a lot more, many more institutions that are coming in to contribute project development capital, but you need more of that. And that's why one of the instruments that we've also seen as being very productive has been Climate One. And we think that what Climate One is doing is really addressing some of the major concerns, because as a private investor, and when I sit in my investment committees, I still have to meet a fundamental return. It's still a commercial return, but the risks are still great. You have to go through your project development stage, the construction stage, and operations. Fortunately, as a DFI, we have the mandate to invest at those stages. But the commercial investors do not have the mandate to invest at those stages. They only have the mandate to invest if it's de-risked and if there's a fair return. And so we've had the chance to invest early, but what we also need are all the sources of capital from a concessionary standpoint and from a policy support standpoint to help. One of the challenges with investing in Africa is uncertainty. So you not only have the uncertainty of the project and the uncertainty of the climate financing environment and project, but there's also the issue of just uncertainty of government policy. And this is where it's very important for the summit, if you will, to really work with African governments to get the buy-in, to really sort of understand the impact of climate change on Africa and how we are the most vulnerable, and to have policies that are going to somehow be linked to an accountability framework which allows the policy to be stable. And that's very important from an Africa perspective. As AFC, we're trying to do a bit of policy advocacy work. Our role in the Innovation Lab is also to be more involved in how instruments are designed, but also to create a platform for us to engage in policy. Now, one other sort of unique aspect of our organization is that we invest across the capital structure. So we do project development, we do equity, we do debt, we do mezzanine, we do everything. And that's been very interesting for climate finance. And it basically speaks to the need for a lot of, for institutions that can have that type of flexibility. And through organizations such as the Innovation Lab, by pulling together all of these different nodes of the capital stack, you're able to actually replicate a completely flexible balance sheet, but contributed by different organizations. And so we think that's been very powerful.
Thank you so much. I think that's been a great set of opening remarks. I do have obviously a number of questions already, but I'd like to involve you here. So if there's any questions from the floor to the panel, please just introduce yourself quickly. I'm not sure whether we have another mic.
Thank you so much for the panelists. And actually, coming from a science background, I know that COP21 has started a very interesting process, which is to get the global community to stick to a 1.5% reduction in terms of global rise in temperature. And here comes the private sector, which is, I think, what is supposed is that it's more flexible, more ready. And I think that based on a common sense approach, being a scientist and being also a policymaker, is that they can get the job done without going through the total policy structure and just, like, let's say, a global network of renewable energy companies going not through comfortable zones, more uncomfortable zones. I am from Mauritania. And I know that the government is kind of lacking to action, but I know that a company that has this renewable energy philosophy would very easily reach to the consumer, get the product going, and get also the benefit not only to the consumer, to the company investing, but also to the global market. My question to the panelists is the following. Where is the private sector and funding going into encouraging these companies that are doing a great job making the PV technology, like for example in India, very affordable and competitive? Where is this link between these companies and the global share in energy providing? I mean, that's the question. What is this bridge between policy, private sector, and individual companies? Like, for example, the steel company of Lakshmi Mittal, for example, is like everywhere. So we want an equivalent energy renewable company that just takes the lead without going to the policy, administrative, long,
Okay,
so
I think I already have like several volunteers here, but let's take two more questions. There's two questions over there.
Hello, I'm Jeanette Gurung, and I'm with WOCON, Women Organizing for Change in Agriculture, Natural Resource Management. I came to this meeting, sorry, how's this? Okay, I came to this meeting because of the title of what you were offering here, Innovative Finance Models that Enable Those in Need and Enable Scaling. And I think we've heard a lot about the scaling, and I'm wondering, who were you referring to when you were talking about those in need? And I would like to refer to something that Rachel Kite said this morning in an earlier session, which was this is not only about the Paris Agreement is not only about decarbonizing, it's also making sure no one is left behind. So any of your panel members who could refer to that.
Very important point, and thanks for raising that. One more question, thank you.
Hi, my name is David Ambush from France. I love the idea that there is $400 billion going to renewable investment, but I'm a little bit afraid that there is so little money now going to real innovation. Ms. Duarte has been talking a little bit about that. She spoke about CSP. My previous job was to support clean tech startup, but now I don't even support clean tech startup because there is no more money anymore for them. There's a lot of money for renewable plants, 200 gigawatt, 500 gigawatt, what you want, but almost no more money for real innovation. And I think that could be a little bit dangerous. Maybe we can spend 10 years now doing larger and larger and larger PV plants, etc. But the next generation of PVs, the next generation of battery, it will come from venture investment, it will come from venture funds, and right now I don't see any more of this money. And if you go all this panel today, etc., you see no venture fund, you see no startup. That's something terrible.
Great, thank you. And one last question.
Hi, I'm Rachel O'Reilly with CBL Markets. And adding to Jeanette's question, hi. One thing that I'm hearing a lot is the decarbonization piece of it, which obviously is incredibly important in our energy space. I worked on the RED Plus model for 5 years and know how important it is that we also protect what's left of our natural world and invest directly into that, even if there isn't a technology model within that that can be commoditized. So my question to you all would be, what are the investment tools that you're seeing working in those spaces that are protecting these essential areas that we need to protect in tandem with decarbonization if we expect to meet our SDG goals and have all of these other international climate goals met? And I know the IFC recently made a big announcement with an investment into Wildlife Works, Cascade Corridor Project, and some other things, so awesome. I'm excited to hear more about those things.
Great. Thanks so much. And maybe let me just, before I hand back to the panelists, as we've been putting together the session, to your question and who are those in need. I think we certainly see that, it's the Paris Agreement and the SDGs, which really, provide the framework for, where we need to understand, that we not only decarbonize and, work on activities and financial instruments that actually help, address mitigation and adaptation, but also that we address, the needs of the 1.2 billion people that still lack access to energy. And I think many of the instruments that we are actually developing are both addressing the energy access issue and also at the same time, how you can actually provide reliable energy, green energy to those people. So it's for sure at the lab, it's one of the core issues that we're doing. But let me hand back. Who wants to start? Maybe I'll just start again with Vikram and let's go back.
I'm not going to try and address everything. I'll let Paddy declare Aqua as the global renewable, not philanthropist, the global energy company. But okay, so let me start with the last question first. So thank you for bringing that up. It gives me an opportunity to talk about something else we announced about 10, 12 days ago, and working with Bank of America and a few other banks. But most critically, this is the first time ever that the capital markets were linked to conserving forests using the RED Plus approach. So IFC issued a $152 million bond. Let's take it offline as to why the 152. But it was, we had hoped to issue close to $7,500 million bond, so clearly there's interest. The idea here was to actually take what capital markets have to offer, which is long-term patient capital in many ways, start introducing them to, and this is going beyond renewables, like you said, as to the need to protect our forest cover. Because with that comes those in need. Because forest cover, many in this audience are probably bigger experts. For full disclosure, I was a mitigation guy till we started to look at resilience and forestry. The issue there is communities have to be addressed, alternative livelihoods have to be created, because those are the drivers for deforestation. So you're not going to address it simply by putting up a fence and hoping the trees grow, right? So where do communities get the meat? Conservation of animals, if conservation of animals kicks in, where do they get their charcoal from if the hardwood is protected? What about the alternative livelihood? So we picked a showcase project that demonstrates that with some financing, long-term offtake from linking it to the carbon market, you can actually provide for those in need, as well as protect what are going to be the largest greenhouse sinks for us if we are not going to blow our budget, because we are rapidly moving towards blowing our budget. So forestry needs to become the attention. And I'll acknowledge there was some criticism of the bond, because what does this do? Well, it's step one of where we need to go to scale, for the simple reason it brought institutional investors in a conversation with the commercial banks, with the MDBs, with the Wildlife Works, to start to understand what role can they play in ensuring this happens. So, next stop, landscapes bonds, who knows, let's go, let's take this. So, and I'll pitch, there's a roundtable specifically on that at the Sustainable Innovation Forum on Tuesday, so you're invited. And before I hand over the mic, 2 quick questions on the issue of policy and the issue on clean tech. On policy, I don't think it's going to be that easy. I don't think the private sector is going to bypass the whole policy framework. I think we at IFC issued another report identifying $23 trillion worth of investment potential in 21 countries by just looking at their NDC needs. That's not going to happen on its own. It's going to require public-private partnership. It's going to require climate-smart policies from countries. It's going to require the kind of work that Paddy referred to in terms of getting scaling solar. How does Zambia get a 6 cents a kilowatt hour for just a 50 megawatt project? Because that's not scale, but public-private partnership will deliver on that. So it's not only about leveraging private finance, it's about influencing public finance as much, which then links back to ultimately trying to ensure that policy is in place. And clean tech's not lost. There is, this conversation should not be sort of taken to mean that there is no money or investment going into clean tech or innovation. At IFC, we have our own bit. We can take that offline. There are better people here to talk more about that. So I'll turn it over to you, Mafal.
Yeah, and I just want to touch on the point on for those in need. You know, of course, you know, we were framing the discussion at a level, but I'm going to give you a couple of examples. I mean, in our portfolio, for example, we support quite a bit of geothermal investments. Quite significantly, we are supporting in a number of countries, adding 1/4 of the global installed capacity. And if you look at, and again, you know, that's risk capital. Private sector will not go into an early stage exploratory of geothermal for a variety of reasons. So if you look, this is base load, is cheap power into the grid, but there are those early stage risks. So if you look at Kenya, for example, they've started to dispatch geothermal power. Price of electricity came down to the population, to the Kenyan population. Moreover, even here, I mean, in terms of the investments that are being done here in Morocco, it's to provide energy access to Moroccans that are yet not served by the current power system. And we, you know, in our portfolio, again, we are emphasizing quite significantly distributed generation systems and off-grid systems to reach out to those populations that we know will take quite some time for the grid to reach them. And so, you know, we need to devote attention and finance and try to understand which business models will work to provide energy access to those poorer communities. I mean, so those in need is very much a focus of what we do. It's underpinning what we do, and the other, you know, IFC and the other multilateral development banks as well. I think the question on forestry. I mean, Vikram just mentioned the forest bond. I think, you know, the momentum is starting to be there. These are investments. It's the same principle. Do these investments generate a return? And certainly, you know, and it doesn't need to be at the cost to the communities. You have types of investments that actually, you know, provide returns to companies and provide enhanced livelihood to the communities. So same sort of principle of what we were talking about in energy, I can see it coming through in forestry. Of course, you know, there the point on aggregation is even more critical because it is also a sector that it's prone to potentially smaller investments as well. So aggregation to introduce to capital markets will be very important.
Thank you. Let me pick up several questions, but I'll just pick up on the one on the point that Rachel was making and the comments that were made here about inclusive development. We're involved with many energy projects, renewable energy. So interesting enough, we are involved with fossil fuel as well as renewable. Our job is to deliver electricity. But so I can speak about the big difference. What renewable energy ends up being, the plants end up being built in fairly remote areas. Well, regardless of whether a country is rich or poor, the remoter the area is, the more disadvantaged and underprivileged end up living there. So what are we doing? We're a long-term investor. We're going there and putting typically $1 billion somewhere, and we're going to have to live with that community for 30 years. So we don't think about building fences and bringing security guards and dogs. We very quickly recognize that we need to work with the community and develop the community. And that doesn't mean an additional cost to us, because in deploying $1 billion there, we should be able to deploy tens of millions in taking inputs from that community by developing that community alongside us. I'm not just saying it, you can go and see it, just over the Atlas Mountains. Ouazzazate, really remote part of the world. Well, interesting enough, it shouldn't have been so remote, because all of us in this room, I'm sure, watch films, and so all of us have seen Ouazzazate actually, because that's a landscape from many of the Hollywood movies, Star Wars to all sorts of. But funnily enough, other than making movies, even though movies were being made for decades, it remained a very small, 150,000 very poor people region. Just within the last 4 years, and only phase 1 of this project has been built, massive transformation of Ouazzazate. Land values have gone up, enormous amount of investment is flowing in, enormous amount of employment has been created. Yes, some of that construction employment that has been created will obviously come to an end when all the construction effort comes to an end. But that doesn't mean that they're then going to say, oh, they're all going to be skilled people who are then going to be moving and getting work elsewhere and contributing to incomes back home. So there is enormous amount. So renewable energy lends itself to that. The other point I wanted to make, people don't sort of think about this, you can't go and build, manufacture gas turbines in every country around the world. But what you can do is to make a hell of a lot of the components that go into a renewable plant just about in every country around the world. The minute you start deploying, so long as you have leadership and give a clear policy guidance, I am going to, whether it is a country that only consumes 1,000 megawatts or a country that consumes 10,000 megawatts, you say, I'm going to now, within so many years, move to renewables. That is enough of a policy direction and a guidance for industry to start industrializing. And we're not, renewable energy, the fortunate thing about renewable energy is made up of a lot of smaller components, which are much more easier to localize. And we are seeing that. A lot of localization took place on the back of, and is continuing to take place on the back of Noor projects here in Morocco. So the local contents have started to increase fairly fast in these projects.
So let me focus on the energy access related questions. You know, the question is, how can we do more to make sure that capital is coming down to the base of the pyramid so that we're delivering on SDG number 7, right? And the beauty of it is that when you deliver on energy access, you're simultaneously delivering on multiple other of the SDGs. Now, there are some interesting structures in the market. If we focus on clean cook stoves, Bank of America actually has a relationship going on with the Global Alliance for Clean Cook Stoves, where we're trying to figure out how can we bring, hard-nosed commercial capital to bear on this challenge of trying to deploy 100 million, or deploying cook stoves to 100 million households by 2020. And the answer is, it's actually really difficult. It's not easy. Because the companies that are involved in the clean cook stove sector, for the most part, can't absorb large amounts of capital. So that immediately takes out mainstream investors. So you are, unfortunately, at this stage, relying upon philanthropic capital, including our own foundation. You're relying upon highly concessional finance. The Green Climate Fund has a great example of a $100 million fund, which it's put together with Acumen. Acumen is now raising, 75 million to add to the 25 million it's got from the GCF, and that's all for solar off-grid lighting, primarily in sub-Saharan Africa. So there are some emerging examples, and I think as these companies build up capacity, as they get more scale, then we can begin to look at some of the blended capital structures we were talking about previously, where you could imagine philanthropic capital as first loss, concessional coming in at the subordinated level, and then commercial banks coming in probably at the, at the senior level?
I'll just touch on a couple points because I think the panelists have all done a great job. So just to answer the question about, why don't we just have a major company that's going after this space? And I think the reality is that the challenge is so significant that there's really so much that needs to be achieved. And the risk-return framework, especially in the context of time, and the fact that we don't have a lot of time to achieve the objectives, makes it such that we need policy frameworks and incentives to encourage all the parties to come together to do certain actions that normally would happen one after the other, but in this case, they have to happen all at the same time. But at the same time, we do see nodes of great activity that are responding to the demands. For example, the crashing price of the solar panels, for example. So you see evidence of the crescendo in certain aspects that's responding to what's happening here. But I think just the greatness of the task is also just what makes it require so many players. With respect to helping those in need, the reality is that scale in many ways is trying to deal with this, because at least in the case of Africa, with so many unconnected to the grid, the need for small-scale renewable energy to address unconnected communities is very critical. And to the extent that we can have organizations that are able to think about those, to be able to finance those type of small-scale renewable and aggregate them into something that's scalable, or as it becomes a scaled, line of cash, if you will, it becomes something that can ultimately be securitized and banked. But if we don't have that path, we can't serve those type of customers. And the reality is that we will need philanthropic sources of capital. We will need government sources of capital to channel power generation at those very small megawatt increments for those that are unconnected. With respect to innovation, I think one area is innovation is sort of climate technology, but there's also an area that's very critical, especially in the developing economy, which has to do with innovative business models. And innovative business models can be transformational and are actually even easier to finance today, and I think are equally critical. Innovative business models such as pay-as-you-go renewable energy solutions connected to the grid, to networks, and those networks being a way to manage credit risk, are proving themselves to be quite powerful. Challenge is a lot of the players are not capitalized, they need a lot of support, but there's much more of an openness to support them. Hybrid energy solutions to replace diesel energy that's used for towers across Africa. These are, again, other business models that are being contemplated, and these are very real, and the lab is also thinking about that, but a lot of areas, even our organization is dedicating mind space to these business models and to work with other institutions to make those business models bankable.
Fantastic, thank you so much. So unfortunately we're running out of time. I'm just going to take half a minute to kind of try to summarize, I think, what we've heard today, and I think it's been an excellent discussion, excellent panelists here. So I think, the overall context, I think, is positive. There is momentum now. I think the trends are good. Clearly the investment community does think that the energy transition is irreversible, as Abid, as you said. We see the reduced capital costs, we see more opportunities. It's a sign of hope, but we all know, we need the scale and the base. So we really need to kind of ensure that all the investments reach those in need and really make sure that we get on this 2 degrees pathway. So how can finance be a lever here? I think we've heard very clearly that public finance needs to be used most effectively to de-risk, to balance the risks and rewards, basically, to aggregate and securitize, but also to establish a track record and really make sure that there is actually deal flow out there, and at the same time also looking at the new frontiers. And then the private sector, as Betty said, is going to take off. So I think this is exactly what we need in order to really get the investment at scale to have an impact. So I think in this context, what we've heard very clearly from the panelists is just innovation has a key role across different dimensions, collaboration has a key role across the different financiers, and really learning from each other what has worked and what hasn't. And ultimately, however, we do need to have the right policy frameworks in place in order to really make sure that money is flowing. So I thank you all for staying with us, and I'd like to ask you to join me applauding the panel here.